We are now seeing up to 78% of all of the world's gold that, or at least the central bank gold held, is now in the countries that possess it. The central banks who have been buying it hand over fist, and it hasn't stopped. And really, the big buyers are the People's Bank of China, the Saudi central bank, along with Turkey, along with Kazakhstan, along with India. These countries and Poland are buying hand over fist to the point where we now have, it's up many-fold from what it is on a moving average.
Central banks in nations like China, Saudi Arabia, Turkey, and India have significantly increased their gold reserves, with 78% of central bank-held gold now concentrated in these countries. This strong demand aligns with a World Gold Council survey showing record numbers of central banks planning further gold purchases, driven by concerns over interest rates, inflation, and geopolitical risks. Heraeus predicts gold prices will range between $2,450 per ounce and $2,950 per ounce in 2025, reflecting continued robust demand. Andy Schectman, a prominent figure in the precious metals industry, explains that central banks, particularly in countries like China, Saudi Arabia, Turkey, Kazakhstan, India, and Poland, have dramatically increased their gold purchases, with October's tally doubling the 12-month average. China, for instance, is buying through proxies like the People's Liberation Army and commercial banks, bypassing IMF reporting. Additionally, raw materials such as gold ore and silver concentrate from South America are heavily sourced, reflecting a strategic accumulation of precious metals. Andy highlights that there's a significant shift in the custody of central bank gold. Only 22% of central bank-held gold remains in Western vaults like the Bank of England and the Federal Reserve Bank of New York, a sharp decline from 50% in 1972. Many countries are repatriating their gold, reflecting diminishing trust in Western institutions amid concerns over financial dominance and the secure return of assets. This trend highlights a broader geopolitical shift, signaling declining Western influence and a strategic repositioning by these nations in the global financial system. Join us as we explore the video in depth. Remember to subscribe and click the bell icon to stay informed about our latest updates.
So look, the October tally of gold purchases by the central banks doubled that of the 12-month average over the last year. And the central banks are buying hand over fist again. China is doubling down their purchases. They never stopped. And that was evidenced by the import-export numbers out of Switzerland and the United Kingdom. They were buying stuff, as we've talked about, through the People's Liberation Army, which is not reported to the IMF as it would be if it was done by the PBOC. They're buying through proxy banks, commercial banks in China that are not directly reporting that to the IMF as they work on behalf, behind the scenes, of the PBOC. We've talked a lot about how they have been buying doré and concentrate from South America, Latin America. And there was just a report that came out that said 78% right now, 78% of their raw silver is coming from South America at the current time in the form of concentrate. And so, the amount of purchasing that we are seeing, it's probably why we've seen the bullion banks start to cover. I think they realize that the purchasing is not ending. When we saw Trump win the election, there was a euphoria, and rightfully so, as we've talked about, for many reasons. This gave the bullion banks the ability to push the ball down the hill to get it rolling. And the managed money, who was sitting on a lot of profits, capitalized by cashing out, which allowed the bullion banks to push the price further. It kept falling and falling and falling. Gold fell by $200, and a lot of those short contracts were covered. But this was an opportune moment, really, for the central banks who have been buying it hand over fist, and it hasn't stopped. And really, the big buyers are the People's Bank of China, the Saudi central bank, along with Turkey, along with Kazakhstan, along with India. These countries and Poland are buying hand over fist to the point where we now have, it's up many-fold from what it is on a moving average. And you mentioned something that we've talked about a lot as well, and that is the repatriation of gold. We've talked about that for a long time, how the West has lost its, you could say, its trust. It's the fact that these countries don't want to keep their gold or silver any longer at the Bank of England or at the New York Fed. And as we've said a lot, The Bank of England gives direct access with safety, supposedly, to the London Metals Exchange, or the LBMA, and the Bank of Federal Reserve Bank in New York to the COMEX. We are now seeing up to 78% of all of the world's gold, that, or at least the central bank gold held, is now in the countries that possess it. So in other words, another way of saying that is that that's it. 22% of central bank gold is held in these locations to give direct access to the COMEX and the LBMA. So, 1 out of every 4 ounces, the rest has been repatriated. This is a big deal. In 1972, it was half of the gold. 50% of it was held. It's a big deal. And it really, I think, goes to show that these countries are no longer trusting that we will even repatriate or return their gold, rather, just like what happened to Venezuela. It's a big deal. And I think it will continue to happen. Not only are these institutions draining the world's supply, but they're no longer leaving it in custody with the West. Big deal.
Andy Schectman, in a recent interview at Liberty and Finance, exposes that gold and silver prices are surging, with gold futures up over $60 per ounce and silver futures showing a 3% premium over London spot prices. This spike is driven by rumors that the Trump administration might impose tariffs on imports of precious metals. In response, banks with naked short positions scramble to cover and repatriate metal from London before potential tariffs take effect. Such measures could lead to a massive short squeeze, pushing gold prices above $3,000 per ounce and silver significantly higher. The spread between futures and spot prices underscores traders' anticipation of further price hikes. This situation highlights the precious metals market's sensitivity to policy changes and geopolitical risks. Massive short positions, 700 million ounces of silver on COMEX and 4 to 6 billion ounces on the LBMA, add rocket fuel to the potential for a rally. With gold nearing $2,730 and silver surpassing $32, while cryptocurrencies dominate public attention, these developments in precious metals could signal the start of a substantial rally. Now, let's dive into the interview.
Is something that I think it's very interesting going forward with the Trump administration, and what's going on with the premiums and the futures price in gold today was up by over $60 an ounce, or 2% above the New York or the London spot. Silver was up $1 over London spot, a 3% difference. This is on the futures, and the reason that this is happening is that there has been rumor that Trump is going to put tariffs on precious metals that are coming into the country. And you have all of these naked shorts that are freaking out, and they don't have the metal standing behind the naked shorts. So they have to get it now, close out their shorts and cover now, and bring the metal home from London before the inauguration, because this is a preemptive risk hedging, I guess you could say, with these banks that are, I think, facing existential threat on something like a massive short squeeze. Well, this is how it happens. If he really does puts tariffs on gold and silver, you will see a massive drive to cover short positions that are back naked, and the metal has to come from somewhere. Often it does come from London. They would end up putting a 10%, a 15%, who knows how high that tariff is. But this is why you're seeing short covering that pushed the price up over the last few days. And this is also why you're seeing a big spread between London spot and the futures by as much as 3%. These traders are basically saying, if we don't do this now and close out our position, if he puts the tariffs on, we're dead. The price can go to the moon, well over $3,000 an ounce in gold, and much, much, much higher in silver. So much so, and I don't like to make predictions, but I would make a prediction that we see a really strong rally into the end of the year as a result of this. And this is just the very beginning. It will be an interesting thing to watch. We'll see what happens over the next few days. This is similar to what we saw during COVID. It was the other way around. There were big premiums on on spot over future. The other way around here, not there, because there was worry about the ability to get metal here because of the supply chain disruptions. And so you would see the price $70, $80 higher than the futures price. Well, it's the other way around now because they're basically saying in the future, you put these tariffs on, prices are going to go way higher. And you look into the on the futures market right now and look into the March contract, and the prices are way higher than spot is right now. It's very bullish for both gold and silver, and underscores how stupid these banks are. It also underscores the sensitivity of the precious metals market to things like policy developments or geopolitical risks, where just like that, things change. And this is all happening kind of under the radar as most people are fixated on what we've seen with cryptocurrencies. They're not noticing this. And here we are right back up above 2,700 as we speak right now. The gold is almost 2,730, pretty darn close to where it was before all of this started. Silver is just over $32 an ounce. So we're climbing right back to where we were. The banks were able to cover a bunch of their shorts. And here we go, back to the upside again. Only now you have something that could potentially usher in, honestly, a real squeeze. A squeeze because these short positions are massive. 700 million plus ounces of silver on COMEX, 4 to 6 billion ounces short on the LBMA. I mean, this is rocket fuel type of potential if this continues to move the way that it is.
The escalating accumulation of gold by central banks and the surging precious metals market underscore a pivotal shift in the global financial landscape. Geopolitical risks, policy developments, and strategic moves by nations are reshaping trust in Western economic systems and driving significant changes in market dynamics. As these trends unfold, they could herald a new era of financial realignment and market volatility. How might the continued repatriation of gold and diminished trust in Western institutions impact global financial stability? What policy measures could mitigate the risks of a massive short squeeze in the precious metals market? We value your thoughts, so please share them in the comments. If you found this content valuable, please give it a thumbs up and remember to subscribe to stay informed. Thank you for being part of this journey with us.